I need somebody help, not just anybody
Help! I need some help, Dad. Help or HECS debt. You might have got it when you're at uni and you've still got it today. But what we didn't get is that it affects your borrowing capacity pretty well. So Nados?
So today we're going to go through everything you need to know about your HECS debt and how it's going to impact your ability to borrow and what it really means for you. So why don't we dive right in? So Jayden, I guess to get us started, what do banks think of help debts or HECS debts?
HECS or help debt was a scheme that the government introduced a fair few years ago that allowed people to go through university or higher education and not have to make upfront payments. The good thing is you could go through uni and not pay $1 and not have to worry about it until you started working. And then now you might see it every month on your payslip. And what a lot of people don't realize is the banks look at this too, and it reduces and impacts how much you can borrow. So Nados, how do the banks actually look at HECS debt or help debt, and how does it impact you really?
Like a personal loan or a credit card or a car loan, the banks include this in your assessment in which they work out and determine how much you can borrow. Now, HECS is based on your total income and it's a percentage of your income, which is an ongoing commitment or what the banks see as a liability ongoing. Now, this liability is included when they assess what you can borrow and will reduce the amount in which the banks will endeavor to lend you.
Now, the good news, if you're getting paid under $45,000 or if you live overseas, weirdly, you won't have to pay any HECS debt. So your borrowing ability won't be impacted by this yet.
That's right, Jayden. You don't start paying your HECS debt until you hit 45,000 or higher. So from 45,000, the government takes 1% of your income per year in repayments for your HECS debt. Now this starts from 1% and goes all the way to 10%, a sliding scale dependent on how much income you're earning. So for example, if you're earning $100,000, the HECS repayment per annum is 7%. So 7% of your income per annum is going towards your HECS debt and will be included as an ongoing liability in your assessment, which then impacts your ability to borrow.
Now, interestingly, different banks, again, treat this differently. Some in that scenario would reduce your income from $100,000 to $93,000, then take off tax. Others would tax you at $100,000 and then take off the HECS as an ongoing liability. What this means is it can dramatically impact how much the banks are going to lend you. And in that same scenario, your borrowing capacity could be $100,000 different depending on the lenders and depending on the way they're going to assess your income and your HECS debt.
You might be asking yourself, how can you get around your HECS debt to increase your borrowing power? Well, the first thing I'd say is go and check out what's left on your HECS debt. Now, in the example before, if you're earning $100,000, 7% is the benchmark amount that you have to repay per year and what we'll use in the bank application. If you've only got $2,000 left on your HECS, we're still going to be using $7,000 as a repayment in your application. So then you might go, well, I might pay off my HECS for $2,000, show the bank proof that your HECS is being paid out and closed, and then that $7,000 will be then removed as an ongoing concern and liability on your application, which therefore increases your borrowing power. So one quick and easy way to get around your HECS and increase your borrowing power is by checking out how much is left, and if it's only a little bit, you might consider paying it out so that we can then use that further income to increase your borrowing power. So Jayden, how else can I increase my borrowing power?
You know, it's a great question. So the first one is unfortunately pretty boring. It's living within your means. So the banks these days are going through your transactions, in some cases line by line, and if you've spent too much on Uber Eats and Deliveroo, the reality is they can knock back your loan because they can say, well, you're spending too much, you're not gonna be able to afford a loan, see you later. So the first one is probably living within your means and just cutting back on discretionary things like luxury lunches and designer handbags, which I know you love, Nate. The second thing is getting rid of unnecessary credit limits. Now, this doesn't necessarily just mean credit cards. It can be like a Qantas frequent flyer card you had from ages ago. It could be a Harvey Norman's interest-free card. It can even be Afterpay. Stuff like that that you're not using, close it, because like you said earlier, a $1,000 limit on that can reduce your borrowing capacity by $5,000. The third thing is be honest with your mortgage broker. When you're going through this stuff, we have to go through the statements, everything line by line. If you know there's an issue, if you've got an outstanding debt, if there's something on there, let us know and we can address it up front and head on rather than find out about it down the track.
So that's it for today, guys. If you're having trouble with your borrowing power, hit us up at huntergalloway.com.au. We can help with your mortgage and sort it all out. Please like and subscribe. And as always, thanks for watching.
Have a nice day.